Most people don't fail financially because they don't earn enough. They fail because their mind is working against them. You've probably seen it. People with high incomes living paycheck to paycheck. And others earning far less, yet slowly building real freedom. That's not luck. And it's not just about money. In this video, I want to show you why financial independence is more psychological than financial. And how small mental shifts can change the direction of your entire future. Before we continue, a quick and important note. I'm not a financial advisor, and I'm not a personal finance expert. What I share here comes from my own experience, from years of learning, reading, researching, and applying what actually works in real life. This is not about getting rich fast. It's about understanding why motivation fades. Why discipline matters most when no one is watching. And why the decisions you make when nobody is paying attention are the ones shaping your financial freedom. If you stay until the end, you'll see why money problems are rarely about numbers. And almost always about behavior, habits, and psychology. Let's get into it. Section 1, The Illusion of Income. Hello everyone. Let's start our financial journey by talking about a fundamental concept that's often invisible but incredibly powerful, the illusion of income. From the very first money we earn as kids to the salary we receive as adults, money shapes our choices. But our relationship with it is often guided more by perception than by reality. The so-called money illusion is exactly this mental trap. We focus on the nominal value, the number we see on our bank account or paycheck, and forget to consider real purchasing power, which is quietly eroded by inflation. In simple terms, we see money for how it looks, not for what it's actually worth. That explains why many people firmly believe that real estate is always a guaranteed investment, without analyzing real returns over time. Or why we feel richer after a 3% raise in a year when inflation was 5%. In reality, our purchasing power declined, but the comfort of seeing a bigger number makes it feel like progress. This illusion has serious consequences. When it comes to saving and investing, we dramatically underestimate how much we'll need for retirement. Why? Because we think in today's dollars to cover tomorrow's costs, ignoring the fact that 30 years from now, living expenses will be significantly higher due to accumulated inflation. The same illusion distorts how we see debt. When nominal interest rates are low, like we've seen in recent years, borrowing becomes tempting because the monthly payment looks affordable. But does it still look cheap when you factor in inflation and the opportunity cost of your money? So how do we break free from this illusion and see financial reality more clearly? The first tool is education. You need a solid understanding of how inflation, compound interest, and market cycles work. Knowing, for example, how the Federal Reserve influences interest rates and how supply and demand affect prices gives you a much sharper perspective on the real value of your income and investments. Second, change the way you measure returns. Always think in real terms, meaning after inflation. A savings account or fixed income investment earning 5% a year in an environment with 4% inflation delivers a real return of just 1%. That 1% is what truly matters when you're building long-term wealth. Third, diversify. No asset exists in isolation. Real estate, stocks, government bonds, and other investments are all interconnected and move in relation to one another and to the broader economy. A diversified portfolio is your best protection against unexpected devaluation of any single asset and against the long-term effects of inflation. Here's a powerful mindset shift: treat your savings like a business. Imagine you're the CEO of Your Wealth Incorporated. Your final product is the growth of your net worth. And your biggest operating cost? Inflation. For your business to be profitable over time, your wealth must consistently grow faster than that cost. Monitor inflation regularly, not to panic or change your strategy with every headline, but to use it as a guiding light when making major decisions about spending, investing, or borrowing. Finally, and perhaps most importantly, have a plan. The money illusion thrives in the absence of direction. A solid financial plan, ideally built with a fiduciary advisor who understands your reality and long-term goals, becomes a powerful ally. This professional keeps an eye on markets, tax changes, and monetary policy, adjusting strategies so your money works efficiently, supporting your present life while building security for the future. Forget the illusion. Focus on real value, purchasing power, and sustainable growth. That's the kind of financial reality truly worth pursuing. Section 2, the psychology behind bad financial decisions. Let's talk about what really drives our financial decisions. For a long time, the world of finance was built on a simple assumption, that we are rational beings who analyze spreadsheets and make mathematically perfect choices. But reality tells a very different story, doesn't it? Behavioral finance emerged to show us that the human mind is not a calculator. In fact, our wallets are governed just as much by emotion, bias, and mental shortcuts as they are by logic. Think about it for a moment. If we know we should be saving, why do so many of us still end up spending more than we should? The answer lies in a web of psychological factors. Many of our financial decisions are not made in our best long-term interest. They're driven by social pressure, emotional states, or habits so deeply ingrained that we barely notice them. One of the most powerful forces at play is social comparison, the classic idea of keeping up with the Joneses. Around 40% of people admit they make purchases just to keep up with the lifestyle of friends or family. This leads us to buy things we don't actually need, simply to feel like we belong at the same level, completely throwing off our long-term financial plans. In a consumer-driven society, material goods often become a measure of status, and resisting that pressure isn't easy. And it's not just other people influencing us. Our own emotions are major drivers of spending. Who hasn't engaged in a bit of retail therapy after a stressful day? About half of people admit they shop to improve their mood, whether out of boredom, stress, or sadness. The relief and happiness are temporary, but the regret and financial instability that can follow are very real. Behind every financial choice, from saving for retirement to managing credit card debt, there's a complex psychology at work. And some cognitive biases are repeat offenders. One of the most powerful is loss aversion. We feel the pain of a financial loss much more intensely than the pleasure of an equivalent gain. This can make us overly cautious, pushing us to avoid any risk at all, even when taking some risk is necessary to grow wealth over time. Then there's anchoring bias. We get stuck on the first piece of information we receive. For example, if a stock once traded at $200 and later drops to $50, our mind still believes it's worth $200, distorting our decision to sell or buy more. And one of the most dangerous biases for everyday investors is the disposition effect, the tendency to sell winning investments too early out of fear of losing gains, while stubbornly holding on to losing investments, irrationally hoping they'll come back. This behavior is the exact opposite of a sound long-term strategy. Now consider a classic and very revealing example, the lottery. Many low-income households in the US spend hundreds of dollars a year on lottery tickets, while at the same time, around 40% of families would struggle to come up with $1,000 for an emergency. Often, these are the very same groups. Is that rational if we look purely at the math? No. But psychologically, it makes sense. For people living paycheck to paycheck, the lottery isn't just a game. It's a ticket of hope, a small chance to reach a level of comfort that otherwise feels unattainable. It's a mental shortcut for coping with limited opportunities. So how do we build defenses against these psychological forces? The key is self-awareness. The first step is accepting that you are not immune to these biases. No one is. From there, we can design systems that protect us from ourselves. One of the most powerful tools is automation. Setting up automatic transfers to your investment account or emergency fund on payday removes the need for an active decision every single month. It helps beat procrastination and reduces the temptation to spend what you never see sitting in your checking account. Another important tool is tracking. Keeping a spending journal or using an app to clearly see where your money is actually going increases awareness. You start noticing patterns like, I spend more when I'm stressed, or I tend to impulse buy whenever I see promotions in my email. Finally, understand that your environment shapes your decisions. This is what we call choice architecture. Turn off promotional notifications, unsubscribe from tempting newsletters, and avoid carrying your credit card into places where you know you tend to overspend. Make good decisions easier and bad decisions harder. Remember, the goal isn't to become a cold, emotionless calculating machine. It's to understand your emotional and social triggers so that when fear, greed, or social pressure show up, you already have a plan. You're in control, not your biases. That's the foundation of a healthier, and ultimately more prosperous, relationship with money. Section 3, Why Discipline Beats Motivation. Let's talk about one of the most important pillars of building wealth, something far more reliable than any trendy investment tip, discipline. A lot of people believe the secret to financial success is staying motivated. You know that feeling after reading an inspiring book or listening to a money podcast? You feel energized, ready to cut expenses, build the perfect budget, and invest aggressively. But then, a week or two later, where did all that motivation go? It disappears. And the reason is simple: motivation is like a wave. It comes in, lifts you up, and then it pulls back. It depends on your mood, your circumstances, and some external spark. And you can't build your financial future on something that unstable. The real force behind every long-term financial success story isn't motivation, it's discipline. Discipline is the quiet decision, repeated day after day, to follow your plan even when you don't feel like it at all. It's setting up an automatic transfer to your investment account on the same day your paycheck hits. It's contributing to your 401k or IRA month after month, whether the market is up or down. It's saying no to an impulse purchase, not because you feel inspired, but because you made a commitment to yourself. Think about brushing your teeth. You don't wait for a surge of motivation to do it. You just do it, because it's a non-negotiable habit for your health. Building wealth works the same way. It's not about knowing what to do. Most of us already know we should spend less than we earn, invest early, and avoid expensive debt. The hard part is doing it consistently, over decades. And this is where real investors separate themselves from dreamers. Success doesn't come from the excitement of chasing a hot stock or jumping into the latest cryptocurrency because it feels right. That kind of behavior is driven purely by emotion and almost always leads to bad decisions. The disciplined investor, on the other hand, builds a solid plan and sticks to it. They don't let alarming headlines or collective euphoria dictate their actions. They stay the course. That kind of consistency, through good markets and bad, is what wins in the long run. The good news is that discipline isn't a personality trait you're born with, it's a skill anyone can develop. And it starts with small wins. Don't try to completely overhaul your finances overnight. Start by setting up one automatic transfer to savings. Cancel a subscription you barely use. Commit to tracking your expenses for just 1 week. These small actions create momentum and prove to you that you're capable of following through. The next step is brilliantly simple: remove friction from good decisions. Want to save more? Automate it. Want to stop impulse spending? Delete shopping and food delivery apps from your phone. Want to invest consistently? Set up recurring contributions. The goal is to remove the need to make an active decision every single month. You don't have to rely on willpower, which is a limited resource. When a system is working for you, to stay on track, track your progress. Watching your net worth slowly grow, or seeing your debt steadily shrink, is incredibly motivating. Use a spreadsheet, a budgeting app, or even a simple note on your phone. Turning abstract sacrifice into visible progress makes the journey feel real. To put this into practice, set crystal clear goals. Instead of saying, "I want to be rich," define something specific like, I want to save $20,000 for a house down payment in 4 years, or I want to max out my 401k contributions this year. Clear goals give your discipline a tangible purpose. Finally, separate emotion from decision-making. Before any major purchase or drastic change in your strategy, pause. Ask yourself, is this aligned with my long-term goals, or is this just fear or greed talking? Discipline is about making that check-in with yourself and choosing the less exciting, but smarter path. Remember this, discipline isn't about being perfect. It's about being consistent. It's about getting back on track quickly when you slip. Motivation might be the spark that gets you started, but discipline is the engine that takes you all the way to the finish line of financial freedom. Don't wait to feel inspired. Build systems. Create habits. That's what ultimately builds a strong, lasting financial reality. Section 4, Identity Shift, from Consumer to Builder. Now let's talk about a transformation that goes far beyond numbers and spreadsheets, an identity shift. Many people see themselves, first and foremost, as earners. The focus is on what comes in, the paycheck, the bonus, the income. In that mindset, spending often becomes a marker of success. The newer car, the bigger house, the luxury vacation. Saving turns into something you'll do someday, when there's more left over. Lifestyle automatically adjusts to the size of the paycheck, not to the scale of future goals. But notice the power of a simple change in perspective. Imagine an extra $15,000 a year. In the earner's mind, that might become the monthly payment on a newer car. In the builder's mind, that same money, invested consistently, has the potential to turn into hundreds of thousands, or even millions, over 2 or 3 decades, thanks to compound interest. The income is the same. The identity, and the final outcome, are not. The builder's mindset is fundamentally different. A builder sees themselves as an investor, a planner, an architect of their own wealth. That sense of, who I am, shapes every habit. Every dollar earned stops being just something to spend and becomes fuel for a long-term plan. Saving and investing aren't boring chores or painful sacrifices, they're natural extensions of the person you believe yourself to be. Every spending decision passes through a simple but powerful filter. Does this help me build a better future, or does it pull resources away from that construction? This doesn't mean builders live a life of deprivation. Not at all. The difference is priority. Builders put the structure first and the lifestyle second. They understand that a solid financial foundation, an emergency fund, automated investments, a retirement plan, is what turns a good income into lasting results and real freedom. Comfort and enjoyment come after the foundation is firmly in place. Why is this identity shift so powerful? Psychology explains it through self-identity theory. As humans, we have a strong drive to act in alignment with who we believe we are. If you see yourself as a healthy person, going to the gym and choosing better food stops feeling like effort and starts feeling like self-expression. The same applies to money. When you internalize the identity of a wealth builder, saving and investing become almost automatic behaviors. You don't have to rely solely on willpower, which gets depleted, because your habits are aligned with your identity. So how do you begin this shift in practical terms? It starts with language. Stop saying only, I make X, and start saying, I'm building wealth. That small change sends a powerful signal to your brain. Builders think in decades, not in the next paycheck. They connect every financial decision to a tangible long-term goal, retirement independence, their children's education, buying a home without stress. With that clarity, action follows more naturally. Saving is automated. Contributions to a 401k or Roth IRA are consistent. Protection strategies, like insurance and basic estate planning, are seen as essential parts of the structure, not boring details to deal with later. Even lifestyle upgrades become conscious choices, not impulsive reactions to a bonus or social pressure. The impact of this transition goes far beyond your bank balance. While earners often live with a sense of vulnerability, because their security depends entirely on the next contract or their current job, builders develop deep stability. Their security is growing independently, in assets that work for them. This shift creates quiet confidence, reduces financial anxiety, and replaces uncertainty with a predictable structure. That said, even with the right identity, emotions can still try to sabotage the plan. It's critical to recognize these internal enemies. Fear, especially fear of loss, can push us to sell investments in panic during market downturns, locking in losses and missing the recovery. Greed pulls us toward speculative trends and get-rich-quick schemes, where risk almost always outweighs real reward. Overconfidence convinces us we can time the market or pick stocks better than professionals, leading to unnecessary risk and poor diversification. Loss aversion can paralyze us, keeping all our money in low-yield savings accounts while inflation quietly erodes purchasing power year after year. And social comparison, the urge to keep up with the Joneses, stretches our budgets to buy cars, homes, and experiences we don't truly need, just to impress others, draining resources from building our own future. At its core, the journey from earner to builder is a choice about where you place your energy and your identity. It's about trading the immediate reward of consumption for the deep satisfaction of watching your financial foundation strengthen, brick by brick, month after month. That foundation is what a financially free life is built on. And if this perspective is resonating with you, I'd love to know. Leave a comment and tell me, do you see yourself more as an earner right now, or as a builder in progress? Your answer might help someone else realize they're not alone on this journey. If this video is helping you think differently about money, make sure to like it and share it with someone who's trying to build a better future, not just chase a bigger paycheck. And if you haven't subscribed yet, consider doing that now. This channel is about real conversations, real growth, and long-term thinking, one small step at a time. Remember, this isn't about overnight transformation. It's about consistent, intentional choices that compound over time. Stay focused, stay patient, and keep building. Section 5. Emotional traps that delay financial freedom. Let's go deeper into a topic that rarely shows up in spreadsheets, but ultimately determines the success or failure of millions of investors: emotional traps. When people talk about investing strategies, they usually think about balance sheet analysis, market trends, and diversification. All of that matters. But there's another force, quieter and just as powerful, that often makes the difference: your own psychology. The truth is, even well-informed investors can see their plans derailed by deeply ingrained mental patterns. This isn't about occasional mistakes. These are systematic tendencies of the human mind, wired to avoid pain and seek quick rewards, instincts that, in the world of investing, often lead us straight into traps. Behavioral finance research is very clear on this. Many of the most expensive financial mistakes don't come from a lack of knowledge, but from emotions and cognitive biases operating behind the scenes. So let's look at some of the most common traps, and, more importantly, how you can protect yourself from them. One of the most seductive traps is herd mentality. We're social beings by nature, and there's a deep sense of comfort in doing what everyone else is doing. In financial markets, this shows up when people rush to buy whatever asset is trending: tech stocks, crypto, or the latest, hot, investment everyone is talking about. The problem is that when everyone is already in, prices are often near their peak. Herd behavior pushes people to buy at the top, driven by FOMO, the fear of missing out. And then sell in panic at the bottom when collective fear takes over. To resist this pull, ask yourself a simple question: would I still make this investment if nobody were talking about it? Real wealth is rarely built by following the noise of the crowd. It's built through quiet, disciplined strategies. Another major danger is overconfidence, the belief that we know more than we actually do, or that we can predict what's inherently unpredictable. Overconfidence leads to unnecessary risk. Concentrating too much money in a few assets, trying to time the market perfectly, or ignoring diversification because we think we have a special insight. Humility is one of the most underrated investor traits. Accepting that markets are complex and uncertain naturally leads us toward the only strategy that's consistently proven to work: investing regularly, diversifying broadly, and staying focused on the long term. On the opposite end of the spectrum is loss aversion. Psychologically, the pain of losing $1,000 feels much stronger than the pleasure of gaining the same amount. This exaggerated fear of loss can paralyze people, pushing them to keep all their money in low-yield savings accounts, where inflation slowly but surely erodes their purchasing power. Fear prevents us from taking the calculated risks that are necessary for growth. Sometimes, the real loss isn't a temporary drop in an investment's value, it's the missed opportunity to grow over time. We also can't ignore anchoring. This is the tendency to fixate on the first number we see. If you bought a stock at $150, your mind becomes anchored to that price. If it drops to $80, you may refuse to sell, irrationally waiting for it to return to the original level, even if the company's fundamentals have changed completely. Smart decisions have to be based on current reality and future prospects, not on past numbers that no longer matter. And then there's impatience. Our culture celebrates instant gratification, but wealth building is intentionally slow. This trap causes people to abandon solid long-term strategies because they aren't working after a few months, or to constantly jump from one strategy to another searching for the next big win. Impatience is one of the greatest enemies of compound growth. So how do you defend yourself against these emotional traps? The answer is systems. Have a written investment plan that clearly defines your goals, risk tolerance, and strategy. Automate your contributions so emotions don't control monthly decisions. Reduce the noise. Limiting exposure to sensational financial news and TV experts can protect you from impulsive reactions. And most importantly, pause. When you feel a strong emotional urge to buy or sell, create a rule to wait 24 or 48 hours. Very often, the emotion fades and clarity returns. Remember this. The biggest challenge in investing isn't understanding the market, it's understanding yourself. Success doesn't come from making brilliant decisions all the time. It comes from consistently avoiding bad ones, and those bad ones almost always have an emotional root. Master your mind, and you're already halfway to mastering your financial future. Before we move on, I want to be very clear, I'm not a personal finance expert, and I'm not a financial advisor. I'm simply sharing what I've learned, what I do, and what I continue to learn over the years through real-life experience, dedicated reading, and ongoing research. This channel is about learning and growing together, not giving personalized financial advice. And with that foundation in place, let's move on to section 6, the final section of this video, where we'll bring everything together and talk about how these psychological insights translate into long-term financial independence. Section 6, Reframing Financial Independence. And here we arrive at our final destination. Or maybe it's more accurate to say, the starting point of a new way of living. When people talk about financial independence, many think only about numbers, a full bank account, a high income, or the idea of never having to work again. But in reality, it goes much deeper than that. Financial independence is about choice. It's about peace of mind. It's about having the freedom to live life on your own terms. For some, it means early retirement. For others, it simply means living without the constant weight of debt. And for many, it's the flexibility to change careers, slow down, or finally pursue a passion. And it all starts with one simple but powerful question. What would you do if money were no longer a constant concern? Take a moment to visualize that. Where would you be? What would your day look like? Who would you be sharing that life with? That vision isn't fantasy. It's your guiding light. But a vision alone doesn't build anything. It needs strong foundations. Everything starts with awareness, knowing exactly where you stand today. Calculate your net worth, add up everything you own and subtract everything you owe. That number, whether positive or negative, isn't a judgment. It's simply your real starting point. Next comes clarity about your daily habits. Track your expenses, every coffee, every subscription, every small purchase, for at least 1 month. It may feel uncomfortable at first, but the truth is simple. Clarity is freeing. You can't take control of what you don't see. With that clarity, it's time to draw the map. Set smart goals. Instead of saying, "I want to save more," turn it into something concrete. I will build a $5,000 emergency fund in 10 months by automatically saving $500 per month. Specific, measurable goals with deadlines are what turn vague intentions into real action. To support this plan in everyday life, structure matters, and one of the simplest frameworks is the 50-30-20 rule. After taxes, allocate 50% of your income to needs, 30% to wants, and the final 20% exclusively to your future, debt repayment, savings, and investments. Speaking of debt, for many people, it's the biggest obstacle on the road to freedom. This is where strategy becomes essential. Prioritize high-interest debt, especially credit cards. Choose a method. The avalanche or the snowball, and stay consistent. And if things feel overwhelming, negotiate. Many creditors are willing to adjust rates or payment plans. Every dollar that doesn't go toward interest is a dollar that can start working for your future. That's where investing comes in, not as a get-rich-quick scheme, but as a long-term, patient process of making your money work for you. Tools like a 401k, a Roth IRA, and diversified index funds exist for this reason. The key is time, diversification, and consistency. And none of this lasts without the right mindset. Living below your means isn't about deprivation, it's about consciously choosing where your money truly adds value to your life. Automating your finances turns discipline into a system. And continuous learning ensures you keep growing as the financial world evolves. In the end, financial independence isn't a date on a calendar. It's built daily, through small choices that almost no one sees. And maybe the most important reflection is this. The life you want doesn't require perfection. It requires direction. If this video resonated with you, if something here connected with your reality, start today. Not tomorrow. Not when everything feels perfect. Start with the smallest step you can take right now. And if you want to keep walking this path with me, learning, reflecting, and improving step by step, subscribe to the channel. Hit the like button, it really helps the channel grow. And leave a comment below, what was the most important insight you took from this video? Thank you for staying until the end. Take care of your choices, they quietly shape your future. I'll see you in the next video.